Let's bring in Marc Lipschultz. He's the co-CEO of Blue Owl Capital, one of the street's biggest private lenders, managing more than $235 billion. And it's great to have you here, Marc. Welcome.
Terrific to be here. Thank you for having me. I'm sorry it's in the context of these tragic fires out west, where we all have a lot of friends and clients and partners, and our thoughts and prayers are with them. But thank you for having me here today.
I appreciate that very much, of course. And, you know, we look across, a lot of the real estate developers we've talked to in recent years, I mean, a lot of them say they're turning to private credit for financing. Yeah,
one of the I'd say maybe mega trends, if we want to use an overused word, is this migration of more traditional asset-backed markets into the private markets. I think you're hitting on one of the core themes that we see this year and going forward. We acquired, as you know, Atalaya, who's one of the best in the business at asset-backed lending. And the kind of lending you're talking about around properties and residential packages is exactly what asset-backed provides. And I think direct lending being the analog, we're going to see a similar migration from those public markets into private markets, offering large cap durable solutions.
Yeah, I mean, as we know, kind of liquidity goes where it needs to go. And, you know, at some point, if people can't get a loan from the banks, they're going to turn to private credit and say, hey, at least this is an option. You know, when the bank's loan goes bad, they have to hold capital against that. What about the private credit world?
Well, listen, we all focus entirely on credit management. The key for us, of course, is we have long duration capital and we use very little leverage. So thankfully, we've been able to originate over $100 billion of loans. And look, we've run at a 10 basis point realized loss rate. So we've had losses that sound almost like IG losses. But adjust that however you will. The bottom line is, unlike a bank, our money is locked up. Unlike a bank, we do not use much leverage. And most importantly, we don't have any depositors. There's nobody standing behind us. This is private capital taking on a well-managed risk in the hands of a professional investor like Blue Owl. There's a wonderful role for the banks in the financing ecosystem. There's a wonderful role for private credit. You know, they're complementary, but our structures are very different.
Well, I think that's interesting, although we did learn with long-term capital management at some point, if you're systemically important, it doesn't matter if you have depositors. I'm not saying Blue Owl is LTCM in terms of size and heft and, you know, all of that. But, you know, at some point, if the big players are, that's all I'm saying. The other dynamic that I think about a lot, maybe you can shed some light, is for interest rates. I mean, okay, so for a lot of these things, the higher rates are, the better investors are going to do. But can the companies really afford it? You know, a lot of this is floating rate debt.
It is floating rate debt. And so a higher for longer environment, which has been what we've anticipated candidly for the last 18 months, and now clearly is the consensus as a directional matter, is very good for our investors. You raise exactly the right question. It's very good, of course, to a point. Right? There's some level of interest bills, interest burden that are too troubling for the companies to carry. But we've stress tested that. You know, the thing about private credit is we've now run a lot of years through a lot of different environments, through COVID, through the bank meltdowns around Silicon Valley Bank, through high rates. Remember, we had SOFR well over 5, and we've tested the income statements as of the owners of these businesses. And the great news is it works. They are durable to anything like the current rate levels or realistic bands around them. Again, surely there's some version of hyperinflation and certain rates that would not be manageable, but I don't think we have a realistic expectation that that's going to happen.
Yeah, and again, the growth speaks for itself. You know, I'm awaiting the big talks from regulators. You know what's coming. Someone at the Fed and someone, maybe not in the next couple of years, but at some point, you know it's coming.
Yeah, we understand that. And listen, we are very transparent, delighted to sit with, work with any regulator. The key point, though, is we have capital that's from one private group being lent to another private user and committed in matched term to its use. So we really provide a stabilizing force. You know, really, I'm not trying to overstate this in sort of a societal sense, but isn't it better to match duration and match risk and put it with private lenders, not on the backs of taxpayers if they end up on the hook?
Yeah, like any new thing, you know, there's going to be a lot of questions. But again, this is what's financing a lot of the activity going on out there. You know, so be it. It's here to stay. It's like the size of private equity as an asset class. It's amazing. Marc, we got to go. It's great to have you on today. Hope to have you back soon.